Here's the problem. We now have a tax-saving opportunity we may never have again. According to the Government Accounting Office, the United States government is more than $17 trillion in debt, but our current tax rates produce barely enough tax revenue to cover the interest payments on this $17 trillion debt. So can there be any doubt that tax rates will go much higher? And if we currently have money in a tax-deferred retirement account like a 401k, 403b, or IRA, we have set ourselves up to pay higher taxes on all of that money when tax rates will be much higher than they are now. Even if we don't need that money for retirement, the IRS will require us to begin taking taxable distributions at age 70, which means that the IRS has a lien against our savings that could be as high as 50%, 60%, or even 70%. So why would we want to defer our tax liabilities at relatively lower tax rates only to pay taxes on all that money plus all the growth on that money at much higher tax rates? Wouldn't it make more sense to pay the lower tax now only on the money we initially deposit and avoid the higher tax later on all of the compound interest we earn on the growth of our money? Of course it does. But how? With Internal Revenue Code Section 408A, also known as a Roth Retirement Savings Account. A Roth retirement account does not defer our tax liability. It exempts our tax liability, but only after we pay tax on any deposits. So the money we put into a Roth is initially taxable, but the money we earn on a Roth is entirely tax-exempt, not temporarily tax-deferred, but permanently tax-exempt. A Roth account allows us to earn interest on our money and grow our savings without any taxation, and then withdraw income during retirement, or pass that money on to our families without any taxation. That's because withdrawals from a Roth account are not mandatory during the lifetime of the original owner, as they are with a 401k, 403b, or IRA. And Roth assets may also pass to your heirs, tax-free, which you cannot do with a 401k, 403b, or IRA. And by converting a 401k, 403b, or IRA into a Roth annuity, we can also get a contractual guarantee to credit our money with an interest rate based only on the periodic gains of an equity market index, like the S&P 500, but without any risk of equity market losses, which means that our interest earnings are always preserved, and the growth of our money is always protected from both market losses and taxation. What's more, a Roth annuity can also guarantee that we can withdraw between 5% and 7% from our savings every year for as long as we live. To convert an existing 401k, 403b, or IRA into a tax-exempt Roth account, you must pay current taxes at the time of conversion. But paying those taxes now, at today's lower rates, will enable you to avoid paying those taxes later on a much larger amount and at much higher rates.